Good morning. It's July 16, 5:35 a.m. It's Friday. Happy summer to you, Wawi, and to each and every of our listeners. It has been a good week in Wall Street as we celebrate the first billionaire that has reached space. We also have big banks beating Wall Street expectations left and right, and most, if not all, big tech stocks, also known as FANG, have reached new all time highs at some point this week. Like, for example, if you have invested in one of the index ETFs or stocks that we have mentioned since we have launched our podcast back in May, you would have gained at least somewhere between 3% to 14%. Apple, for an example, has gained 14% in past month. I hope you, our listener, have had a great and productive week so far and have benefited from this rally. This is your host, Mark Yu,
And Wabi Santos.
and welcome to the Mark Yu and Wowie Show. Just a disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record at least once a week. I and Wowie are both physical therapists here in the USA with the same passion and interest in researching and investing our hard earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and provide informed investment decisions to our fellow listeners and coworkers in the medical field. And for those who are our colleagues who work hard each and every day, thank you for all of you guys for your hard work. Remember, there's no one else that will walk that patient after hip surgery or cabbage, aside from the nurses and therapists that carry doctor's orders. Just a reminder for you guys, we are available in YouTube, Spotify, and Google Podcasts for those our listeners who are always on the go. So, on our previous, just a brief recap, we discussed the possible correction or incoming market pullback just because we've been experiencing a lot of all-time highs and how to prepare for it, like having at least 3 to 6 months worth of savings. We dissected the financial numbers and the risks associated if you decide to invest in the soon to be listed stock trading app Robinhood and the already publicly listed Uber of China, or Didi Chuxing, or Didi Global. More importantly, we also previously discussed several warning or stock market crash warnings from the famous Wall Street professionals like that of Leon Cooperman of Omega Advisors, Michael Burry of Scion Capital, aka Big Short, and even including Rich Dad Poor Dad author Robert Kiyosaki. For those who have missed it, feel free to go back and listen to it. We truly appreciate your support. In the meantime, thank you for the feedback from our listeners. Thank you for supporting us by subscribing and liking. This podcast is now maintaining at least 60 to 70 views per episode. Also, I finally invested in a mic. Here we go, improving our quality, voice quality, hopefully. Because some of our listeners were saying that the keyboard tapping that I usually do during recording kind of interrupts the session. So, all right, on today's topic, we have what's up with Wall Street, market industries, the sentiments that's been ongoing. Of course, we're gonna take a deeper dive in one of the stock that's soon to be listed, which is Grab. We're gonna play some audio clips from some of the like market professionals later on, and we're gonna go on with the quote of the week. So for the first topic, we're gonna begin with sharing my screen. It's gonna be celebrating the first billionaire in space. Let's see, and it'll be this screen right here. So this is just showing the recent article about the success of Richard Branson being able to go to space last Sunday. So as you can see here, he was able to take flight on July 11th. But interestingly, in terms of the stock performance, as you can see here, while it looks like it's been falling off a cliff after that intense flight.
Mhm. I wonder what drove that down.
Seems like probably it indicated some sort of like exhausted enthusiasm about the company, but it nonetheless it was a great experience I think they flew for at least 282,000 feet above Earth ground, and they were able to at least spend some zero gravity, sometime in zero gravity for at least 9 to 10 minutes before starting descending down, which is really brilliant, like exceptional when it comes to like people being able to go at least to feel that type of experience in the space.
And how much was the ticket? I think I heard it's like 23 million to
I
be on
know.
that flight.
Like I think for this ticket moving forward, they're charging 200 to 250,000 per ticket, and there are almost like 100,000. I mean, not 100,000, but 100 people who have signed up for future maiden flights, and one
Mhm.
of them is Elon Musk, like a future Virgin Galactic astronaut.
Well, there you go. That's probably why it went down.
Oh, okay. Well, our next topic would definitely be inflation. So this week, the government released inflation data, and it appears that because people are spending their money, inflation is picking back up for sure. Highest in decades, as you can see in this chart. For our listeners, don't worry, it's the highest we've been since last year. I mean, not last year, last decade, about 2007,
Yes.
2008. So definitely prices are rising. Like you could see the gasoline going up by 56%, fuel oil 51, used car 30%, airlines 24%, car insurance, everything is just going up. So it's
Hmm.
definitely good for, people that still trying to look jobs to keep seeking them and try to find a way to cushion this impact because definitely expenses are rising. The thing is, what's good about investors, what's good for the investors is Jay Powell or Jerome Powell. He's the Federal Reserve Chairman who tends to like release his thoughts and information, like deeply economic research, who decides if they're going to raise rates. Is said that the Fed is still ways off from altering policy and expects inflation to moderate. So, in short, he's still thinking that the inflation rate is transitory or somehow it'll still go down over time. What do you think about this, Kuyawawi?
Well, I don't know if it's going to be transitory. I think it's just natural for prices to go up.
Right.
Um, there's still a lot of quantitative easing, right? They're still
Mm-hmm.
buying
Mm-hmm.
at a rate of 120 billion a day,
A month.
um, a month.
Yes. Yes.
So it's not it's not natural, right? So
Yes.
they're slowing it down.
Sure.
But I'm thinking with increased productivity
Mm-hmm.
and manufacturing, it would maybe slow it down some.
Yes.
But
Definitely.
I don't know if we've seen any of that increasing. Manufacturing,
Right.
um, production, is that
Mm-hmm.
increasing? Do you see that on your radar?
Yes, I think our production has been slowly increasing still. Demand for products are definitely up. Some of our listeners may also have heard from other news source that semiconductors are or the chips for cars are still in heavy demand. They're wanting to produce more. So I think overall, we are still in the verge of recovery. So, like, um, just for just for future references, a publication yesterday said that Powell. The title said Powell says Fed would raise rates if inflation risk persists. So for me, this just means that Powell or Jay Powell, as I would like to call him, like pals, but I'm not in any way connected to him. But yeah, so Jay Powell is not totally blinded by the fact that the inflation could actually be on the rise or not even a transitory, and he wouldn't resist to hike rates if that's the case. Just to support our statement that the Fed is still on the verge of recovering, the job openings on this chart is just incredible. Like it's the highest it has been for the past 20 years. So job openings won't be like this if there's no demand for labor or there's no demand for services. And another interesting fact is that people or some professionals, some work professionals, or economists are labeling this period where people are able to find actual work and demand for pay as the Great Resignation. So there's an article from CNBC saying that if you plan to quit during the Great Resignation, quote unquote, here's what career experts say you need to do. So people or employees now or prospective employees have the chance to at least look and demand, like for example, just going to a mall, going shop by shop, asking like how much do they offer per hour. You can actually try to see who's gonna pay you the most before you take that job, which is definitely interesting nowadays. Job openings are plentiful. In the meantime, in addition, we have the consumer confidence. So as me and Wawi have been discussing all throughout this time, stock market has never been better. It's been going up and up and up, except for yesterday, a little hiccup. Oh, Wawi, just it kind of like just popped in my head. Last Thursday also was an interesting point, right? Last Thursday, the market dropped, and
Mm-hmm.
today's Friday. Yesterday is Thursday, and the market sort of like corrected a little bit. So
Mm-hmm.
maybe future doesn't portend what's gonna happen in I mean past won't pretend like what's gonna happen in near future, but it sort of rhymed for interestingly. I just recall that aspect. But yeah, history
It looks
aside,
like every Friday, every Friday the stock market is going up.
right?
It'll drop down
Mhm.
Thursday, and then Friday it'll go up.
Interesting,
So
yeah. So
so
and
we're
this
seeing a little pattern here this past few weeks.
definitely some sort of pattern, and futures are now still slightly positive, so that's a good sign. So moving on, we have a consumer confidence, so it's not all like down and dire in terms of inflation rate. And definitely prices are rising. This is just my take on it. Prices are rising, but consumer confidence, like this is what propels the US economy. Most of the US economy grows through consumer spending. I think 70% of the US economy relies on consumers. So consumer confidence as of June 2021 is really good. It's back at 100. And if you're going to look at history, we're back at 2019 levels. So there was a big dip during the Great Recession, and not the Great Recession, but I would call it as the Great Lockdown. But now we're back at the 2019 levels in terms of consumer confidence. So that's a good sign that the economy is well up and running. Next thing that we're going to look at is a research report by Wallet Hub that they just released. It's a credit card debt spending. This is related to what just happened this week when most of the big banks have already reported their earnings, which we're going to take a deeper dive in a little bit. But credit card debt spending is definitely on the correction end. It's going down. Credit card debt has decreased at least 57 billion during first quarter of this year, which just indicates that people are not buying, but um, paying cash on their credit cards, which is good. Like, for example, on another table, it says here that the average credit card debt per household actually has dropped by 14% during the first quarter. So from average credit card debt, $8,600 last year, now it's down to $7,500. So people are paying down their debt. So what does this mean for the big banks? Because the big banks actually make the most of their money. Like in traditional sense, big banks collect all the savings, they pay minute interest on it, less than 1%, and they're gonna loan it out to the other people that using credit card products for an interest of 20%. So they make that margin in between. But the thing is, they're now showing a loan growth issue. Just because people are paying most of their debt. The moment that they spend a credit card, they pay it down, which is good in terms of personal finance. But overall, it kind of affects the banks earning power. So this report was just published this week. J.P. Morgan and Citigroup experienced a flat growth in their loans. Bank of America and Wells Fargo average loan and lease balance were down like 11 and 12% respectively. So definitely these banks are the latter part or experiencing some hardships in terms of growing their loan products. Um,
I think a big part of
mhm,
their business is in the mortgage
right.
business.
Hmm.
So I'm just thinking here. Um, so I've lived in this addition here in the rural East Texas,
Hmm.
and we have a lot of farmlands. People like to live outside the city limits,
Right.
but now I'm seeing an influx of people moving in within the city limits,
Hmm.
um, and buying land. And at this point, um, it looks like, at least where I live, they're gonna start building more houses here in
Hmm.
this addition.
Hmm.
So maybe people are slowly um, getting into loans, mortgage loans, to
Right.
start building again. Now that the construction supply, for building homes is back, somewhat normalizing.
Right.
So I
Definitely.
think this is what I'm seeing, Mark. So I'm
Hmm.
seeing maybe once the supply of lumber and construction equipment and building materials start normalizing,
Hmm.
we should start seeing more people investing in new homes
Right.
and maybe fixer uppers, stuff like that.
Right. Definitely. Like I feel like they're gonna try to spread out instead of like being just focused on the city centers nowadays.
Hmm.
Because I think the major cities like New York, San Francisco, in a chart I shared like last week or the other week, like we have been seeing some outflow of people and they're going to suburban areas and rural areas to start family because they have more space, and of course the cost in building such living space is a little bit less compared to where they would intend to, like if they stayed in a bigger city for sure.
Hmm.
So that's a good sign as well. Like according before we jump on to the next, the flow show that we have where the money is going. Mike Mayo, a bank analyst at Wells Fargo, um, also had mentioned that he argued that the loan growth will eventually return. It's not just like a matter of if, just when. So at least some analysts are thinking that despite the slowdown in loans, people paying down their credit card debt right away, which results into lower earnings in banks, is a little bit of a hiccup instead of like a gradual trend where eventually banks won't be able to make business in credit card debt. So that's also a good sign for investors in banks. So for the flow show, ETFs just this is a screenshot from Bloomberg. ETFs just had the best first half of inflows on record. So for the first half of this year, there's an incredible more than almost 500 or 400 to 500 billion cash that went into ETFs, and it breaks all records. So going on to the next, we're looking at some flows on specific sectors as of July, as of this month. A Bank of America survey indicated that more money is coming into tech. So they're going back to the growth mode again, Huawei. And then looks like they're
Hmm.
coming out of some oil down here. Energy, staples, emerging
Hmm.
markets are once again losing the money, the investors' money interest. And all of them are going to tech, to telecom, back into the US. So the belief.
Well,
Mhm.
yeah. Well, Mark, do you think this is still because of the low interest rates? Is that why you think this is still existing? This move into tech?
Right. Excellent question, Wawi. I think overall, like what you have mentioned previous on a previous episode last week, that all central banks globally are trying to boost consumer or spending, so they're lowering their rates. And as a result, savings rates are going down. And what else could be more competitive compared to the U.S. market? So I think people are still looking for ways to put their money to work, and the most that they could see, or the greenest of green pastures, as I would say it, is here in the US, and it's on tech. So that's my thoughts on it. It's not investment advice, but that's what I think about it. Over the short term, we could definitely dabble into it, take a closer look. But I think this is what's happening. Like, oh, you know that saying, Wawi Tina.
No, no, tell me about it.
So
What's
Tina,
going?
Tina is a like a abbreviation for there is no alternative. So I
Oh
guess
yeah, yeah,
people
that's
are
true.
thinking that tech is a safe route at this time, given the fact that we actually dissected some of them in the previous episodes, where all of them are, or some of them are, have a lot of strength in their balance sheet, a lot of cash, hundreds and billions of dollars, like for example Google, and of course Apple. So like tech is now like the creme de la creme, as you would see here. Apple is now at 2.4 trillion market capitalization.
Hmm.
Microsoft 2.1. These two are now in the 2 trillion marks, like valuation. That's incredible. Some countries can even reach 500 billion GDP, which we're going to see in a little bit. Amazon is close to reaching 2 trillion as well. Google 1.8 trillion. Facebook close to reaching trillion. So that just shows like the love for these stocks. So the next one is we're gonna look at is the industry performance for the week, at least as of Friday morning. This is as of closing of Thursday yesterday. So materials and banks are leading. I think people have liked or like what banks have shown or reported so far, despite their weakening credit debt growth. But investors are investing or at least rewarding the financial stocks here. Um, in comparison, energy, which is a big winner so far this year, so far this year, has lost at least 3%, almost 3% this week. So usually we would see financials and energy as the reopening place, but this week there seems to be a difference. Financials are gaining, energy stocks are losing. Um, next next slide would show us here the tech juggernauts. So for our listeners, don't worry about it. We're going to be discussing it. As I'd say earlier, the biggest of them all, the big tech, Apple, Microsoft, Amazon, Google, even Tesla and Facebook, all together are now approaching $10 trillion of valuation. As I've pointed out earlier, both Microsoft and Apple alone are like 2 trillion each. Crazy. So next, we're gonna tackle the market sentiments. But before we go to that point, I think I have some more clips of valuations in terms of the biggest tech or big tech. Um, oh well, we're gonna skip that. So for now, we have the volatility index. This is what we have discussed in on our previous two episodes. So for this week, Wowie, our volatility index is down 8%. Not
Hmm.
not much movement, but I think yesterday was kind of, we should have seen a spike, right? For yesterday.
Yeah, but we we don't see that.
Right. So
Hmm.
yesterday I
Oh,
double
there it
checked.
is.
Yeah,
Just
there's
a
a
little bit, two
loss.
point increase.
Yeah, a small spike yesterday. Just 2%. But for this week, it's at least negative 5% overall. So market sentiments in terms of volatility or shakiness is a little bit relatively steady, as I would say. Would you agree, Wawi?
Yeah, it reflects my portfolio. So.
Right. So not much up and down. So next we go
Hmm.
ahead with the American Association of Individual Investors. This is a weekly survey with a lot of investors here in the US, what they think about the market, if they're bullish or bearish. Bullish meaning they're thinking for the market will go up for the next 6 months. Bearish market will go down next 6 months. So as of 7:14, couple days ago, the sentiment ended with a bullish sentiment of 36% compared to the last week of 40%. So I'm seeing a trend here while we were compared to the last week of June, which it was at almost 49%. Looks like the sentiment has been slowly going down. The bullish sentiment, people are getting less optimistic of the market while they're getting more bearish. Like bearish sentiment as of a couple days ago was 27%, compared to 2 weeks ago of 22%. So people are kind of slowly pulling back a little bit, looks like.
Well, they're also going on vacation, so they're
Oh,
they're probably spending some money going
right.
on vacations
Uh-huh.
this time of the year.
Right.
But it's also earning season, so we're in mid-cycle. So
Exactly.
so I think they're just waiting for companies to uh, uh, do their earnings report,
Right.
so they can start uh, putting in money
Right.
on their bets.
So more likely they're looking out, seeing what they have, the companies that they are invested in, how they perform so far, and see whether they have to at least curtail their investment or add to it. Um, Moving on to our next sentiment is the TD Ameritrade. TD Ameritrade, for our listeners, is like one of the biggest brokers out there. They merged with Charles Schwab, which is a very like famous Wall Street broker back in the days. So this is one of the brokerage firms that serves a lot of retail investors. So no change here. Market sentiment for these investors in the TD Ameritrade are still at very high or optimistic range. Fear and greed. So fear and greed is not posted here, but it looks like in one of my charts here in my other window, it indicates an overall downtrend still. So this fear and greed sentiment shows that it supports the American investors survey, which is still the sentiment is still a little bit bearish. So this is in addition to the flow that we have discussed earlier. People are investing in more and more into large caps. So large caps for our listeners are like those that are $500 billion in value and more. So large caps, these are otherwise known as, I would just plainly describe it as the big tech or the FANG stocks, Facebook, Apple, all of those. So people are moving their money, inflows to large caps and outflows from small caps. So small caps, obviously the name defines itself. So these are in comparison, it's not like apples to apples comparison, but just imagine the $10 trillion that the big tech has brought into the market, like rivals that of like Japan. Japan, in terms of its economy size back in 2019, is $5 trillion. Those big tech stocks alone overlaps these countries in terms of capacity to build the um, GDP product, like what the company produced overall. So Germany produced 3.8 trillion, United Kingdom 2.7 trillion. Basically, they kind of far exceed what some of these countries have been able to produce as a whole, which is so much interesting. So another graph here is the Facebook, Apple, Amazon, Microsoft, Google, Netflix. Now we're adding Nvidia. Nvidia is like now for a 400 billion company. It now kind of like added a lot more capital compared to Netflix. I think later on some kind of Wall Street expert would say, oh, maybe Netflix need to be replaced by Nvidia because Nvidia is like double the size now of Netflix. But yeah, these companies are now composed of 27%, more than a quarter of S&P 500. So if one of these stocks, or as a whole like big tech, if they move up, obviously as major component of the S&P, for those who are index investing in SPY or VOO, will definitely experience some sort of lift. If these tech companies also go down, I would probably guess most of the time that the whole index would go down as well. So that's what do you think about these major contribution, Huawei? They're like more than 25% now of the index.
I know, and I think that's why a lot of people are moving into what we've discussed in our group,
Mm-hmm.
direct index investing,
Okay.
wherein the retail investors are investing in these big companies
Right.
in the S&P 500. I
Mm-hmm.
think some people are seeing that these market performance has been stable over the past couple of years and showing a steady growth. So I think that's the reason why they're buying these stocks now.
Right.
Facebook, Amazon, Netflix,
Mm-hmm.
Nvidia,
Nvidia. Yeah.
yeah, and Google.
Mm-hmm. Google for sure. Because I think, yeah, you're right. I agree with you. The stability, the balance sheet strength, you can definitely, see that clearly, transparently in these companies.
I don't
Next.
have I don't
Mhm.
I'm sorry, Mark. I don't
Yeah.
have any
Mhm.
of the other FANG stocks, but I do own Amazon.
There you go.
And although it doesn't match,
Mm-hmm.
the S&P 500 growth,
Mm-hmm.
it's still performing okay below 20%
Yep.
so far for the year
Mm.
on Amazon. But I think we're gonna see a continued trend, people buying these S&P 500 companies
Right.
because of its growth trend so
Right.
far. But
Yeah.
once we start seeing the Fed moving away
Mm-hmm.
from controlling the inflation, then
Right.
we may need to start looking at rebalancing.
Right, definitely. Because the more that you get invested in the tech and growth companies, definitely the more that you're going to be exposed to it. And later on, as it goes, the price goes higher, as we're experiencing now, your portfolio eventually gets to be super like exposed, like what you said. So it's good to look at that for sure in the near future, as we see the evolving changes. Or what's JPOW gonna do next, right?
Yeah, so
Um.
far he's saying that up to 2023,
Mhm.
he's not gonna touch it. So
Yes. Hopefully he sticks with that, but we'll see how it goes. We can never say. So we have just a couple of quotes here from very established analysts in Wall Street, what they think about this people diving into tech. First, we go with Stephen Dover. He's a chief market strategist at Franklin Templeton Investment Institute. So he said here, quote unquote, we have a situation where we are looking at really good numbers in terms of earnings at the same time that we are looking out into the future and wondering whether we can keep these high numbers and certainly whether we can have even better numbers in the future. In a lower growth environment, technology would tend to outperform. So he still looks at this as a possible play in the future, even with low growth environment, that tech would hold on to its lead. Here's another quote from oh well, it's the same person. Here's another quote from another guy, from a Wall Street analyst. Let's see, let me pull it up. This came from Mike Bailey. He's a director of research at FBB Capital Partners, a Wall Street analyst. This quote unquote, this is a big reversal, but part of a regime change. Investors got comfortable with the narrative that small caps and cyclicals would ride into the sunset this year in a grand recovery trade. But that story has faded, but that story faded when interest rates collapsed and tech earnings grew white hot. So he's looking at as it is. Like now that banks are showing their reports, he's betting, he's looking at tech still delivering really strong growth, and investors are realizing that. That's why people are investing in the growth sector, tech sector. So going on to our next, what's up with Wall Street? Bitcoin as an inflation hedge has been losing during these inflation number reports. Instead of like staying flat or gaining, looks like it's joining or reacting counterintuitively compared to the inflation numbers, which is interesting. Um, any quotes on the cryptocurrency, Wowie, in terms of the
yeah,
underperforming?
yeah, it's definitely underperforming this past month.
Uh-huh.
Today, the market is down 3% on the cryptocurrency market.
I see.
It still has to do with um, mining
Uh-huh.
closing in China.
Right.
Um, and I think even the Japanese government is talking about setting
Mm.
up regulations to
Mm.
control the growth of these stable coins.
Right. And what I heard from yesterday's Fed Powell, Fed Powell, Federal Reserve Jay Powell's Senate hearing or Senate interview, when he was like asked one after the other by different senators. Like I think he mentioned that come this September here, Federal Reserve would be updating the public in terms of their progress in the central bank digital currency CBDC. So we're gonna hear from that project pretty soon. Just thought, I guess, because Bitcoin was once believed to be a good inflation hedge. People are saying that once you buy Bitcoin, you'll be protected from inflation. But you cannot expect, for me, my thoughts, you cannot expect a cryptocurrency going up 200% just to keep going up. Like over the long term, it's high risk, high reward in this environment. So more likely, come time sooner or later, or right now, you wouldn't expect like a currency just to or whichever investment entity it is just to keep going up. So Bitcoin is definitely in a correction mode still.
Yes, it is. I
Yeah.
think in the future, if it all depends on how people will use energy in the future.
Mm,
Um, there's a lot of movement to for ESG,
right.
factoring in when people are investing.
Right. ESG for our listeners is the environment, social, and what's the last one?
Governance.
Governance. So
So
ESG. Mhm. Go ahead, Wally. Mhm.
there's concern with Bitcoin using uh, a lot of energy.
Right. Uh,
So
uh-huh.
I think they're trying to use clean energy, moving into clean energy
Mhm.
to mine Bitcoin. And since we lost a lot of these mining companies in China,
Mhm.
there's not a lot of Bitcoin being produced.
Oh, supply and
Um,
demand.
mhm. But well, I listened to Kathy Wood.
Right.
So she is saying that maybe in the future um, there will be some energy trading,
Mm,
and that's probably where things will come into play
right.
when people start producing their own energy in their own homes
Mhm.
and trading that excess energy in the market, and they
Right.
can use cryptocurrency for that.
Mhm.
But I think right now, my thesis on cryptocurrency
Mhm.
lays heavy on Ethereum,
Right.
because there's a lot of development based on Ethereum.
Ethereum. Okay.
Yeah, which is another blockchain. It doesn't use as much energy as
There you go.
Bitcoin.
Because I was gonna ask you, do you think the energy used in Ethereum kind of like at least is not less? I mean, as is at least a little less compared to Bitcoin.
Oh yes, a whole lot less than the energy usage of
Mm,
Bitcoin.
well, that's a good sign.
And
Mhm.
yeah, and banks are already using Ethereum.
Or Ethereum, or it's
Yeah,
it's a
Ethereum
blockchain,
program.
right? Yeah.
Yeah, it's a blockchain.
Okay.
So we know there's already case use for it.
Mm,
And right now they're moving into proof of stake, which basically means, they're not uh, producing coins based on proof of work where they're using up a lot of energy. So
right.
it's called proof of stake.
So proof of state is less energy consumptive compared to what's the other one? Proof of work. I
Proof of
see.
work.
Got it.
Be-
Okay.
because the more people buy Ethereum or hold it,
Hmm.
the more stable that cryptocurrency will be. And
Got
right
it.
now they're in the development process on what they call Ethereum 2. And
Oh,
and right now you can stake, and I don't know the yield. I think it's a 6% yield once you stake your claim on Ethereum at this point.
I see. Well, definitely still an evolving field, Wawi. Good thing that you're exposed to this aspect of investing because I'm definitely not able to follow the cryptocurrency
Mhm.
market.
But
So,
there's a movement towards that globally.
mhm,
People are trying to find a way to produce digital currency that they can regulate. The problem with cryptocurrency is the volatility, and you can't peg your country's currency on something that's so volatile.
mhm,
So there's that movement. China already produced their digital currency. Japan is thinking about it. The US is studying it.
Right.
So, we're just gonna
So
watch and see what's gonna happen.
we're definitely heading there. Changes for sure in our finance field. The next point in our what's up with Wall Street is the meme mania is in a bear market. So I would say like maybe while we looking back at our sentiment discussion, like the fear is definitely still up there. So probably some of the fear is because of this, like people getting stuck with high, very high growing at first, like the SPACs, the memes, AMC, and all that. They were very much enthusiastic diving into it, and now it's in a correction phase. Like it just lost as a group 23%. SPACs, I think, lost a good amount. Some of the SPACs are down 50%, 30%. A lot of like people had lost their money on those aspect. Maybe that's the reason why we're not seeing like very, very, very optimistic sentiments so far. Value in growth, as we've discussed earlier, growth is definitely once again trying to outperform value. Value like the low stocks, the low valuation stocks, which are banks and oil. Um, Next slide would be the Bitcoin versus the S&P 500. So far this year they're at par, almost at the same performance. Interestingly, if you've invested in Bitcoin at the start of the year, and also compared to person who invested in S&P 500 and an index, both of you would have at least some returns that are similar compared to the average, compared to when you just put your money in the savings, which doesn't even yield a percent, which is bad. So this is a Peter Lynch valuation method. It's very tedious, but it's good that we have a simple chart just showing that obviously the market is not cheap. We're at almost 36% or 36 times earnings, or in terms of Peter Lynch valuation method, we're at the highest in the past half a century. We're definitely way up there. We have surpassed the tech bubble valuations just before when the bubble popped. So it's quite worrying, a troubling sign. But what's interesting about this Huawei is what I found out yesterday while listening to a Charles Schwab presentation, is that Charles Schwab pointed this out, that we are still in a recession. Like we are way up there. We've been experiencing a lot of all-time highs, day after day, week after week, and we are still in a recession. The unemployment rate, is still a little bit high. It was 6%, ways down from back in the great lockdown of last year. But NBER, or the National Bureau of Business, hasn't declared that we're out of recession. We're still in a recession. And it's so much interesting because despite this situation right now, maybe NBER is just trying to catch up. They're trying to see whether economic data, because like for example here, the NBER maintains a chronology of U.S. business cycles. So a recession period is a period between a peak of economic activity and its subsequent trough or lowest point. So NBER has yet to announce that it has found like a trough or lowest point in the cycle, which I mean, inflation rate, I guess whatever they're looking at, they're still looking at possible economic recovery.
Well,
So
in your opinion, Mark,
Mhm.
from your experience, when do you see that the NBER normally declares? What time of the year they normally declare
I would say
or make a statement?
right. That's an excellent question because I think they come out with their release every quarter. In my experience, I think NBER looks at quarterly performance. So we're
Mhm.
now done with the Q1, and we just the quarter one for our listeners. That's the January to March, and Q2. Banks have started their earnings report Q2. So I bet by the end of this month, when most of the companies are done with their reporting, if NBER sees, this is my thoughts, 2 quarters of strengthening, then they would eventually, including other economic factors, because I'm not sure, like there's a certain amount of list that they go through, and then they undergo intense review. making sure that the economy is up before declaring that the market is back on track and out of recession. So I bet probably early next month, or maybe next month, July, August, maybe September, they're going to come out with a declaration that we're out of the recession. But at this point in time, we're still technically in the recession. So this is the chart that I was looking for earlier. It zapped down here. So it's just a highlight, a good chart shown here by Charter. For our listeners, it's just showing Microsoft is definitely way up there and Apple in terms of valuation. They're at the exclusive $2 trillion club, and not so far behind is Amazon, Bezos Amazon, Google, Larry Page's Google, and then Facebook is about to breach the $1 trillion mark. Wow, look at that. The Facebook, for our listeners who are not closely following it, Facebook also operates Instagram and WhatsApp. So if you don't use Facebook and you use Instagram, you're still a user, or one of the customers of Facebook. And then Tesla probably trying to bounce back up, and I'm sure Kathy Woods of ARK definitely is a number one cheerleader of Tesla.
Yes,
So
that's for sure.
it's one of her largest holdings, as me and Wawi have discussed a while back in our episode 3. I mean, that lady just, optimistically in EV sentiment. So how do I go about this? Like, just sharing all these information in terms of our stock market. This all exciting stuff definitely begs the question: what now? Do we just sell or do we just hold? So my thought process on this is always going back to basics. As one of my favorite Wall Street experts, Peter Lynch, the famous quote, "Wow, yes, I would have repeatedly say, time in the market always beats timing the market." So if you're not sure what to do, then don't do anything. Just stay invested. Buy every now and then. Stick with whatever. Just follow through with your stocks. Which I think, Wowie, I think it's a good idea. Future on. We've been taking a deep dive for today's episode. We're gonna take a deeper dive in Grab, which is like the Uber of Southeast Asia.
Mhm.
Like we're gonna dissect more and more into these companies' specific numbers. Like for example, maybe we'll tackle Google or Apple or Microsoft in our following episodes and take a closer look at their numbers. How come they're able to generate so much money over time, and not so much people can or companies can beat them? So just time in the market always beats the market. But with that, we're gonna play a short clip here of a famous YouTuber. His name is, well, I don't know his name is, but his channel's name is Beat the Bush. This is not like degrading this person now that we're involving other people in our podcast, but this is just a clip that we're gonna play 1 to 2 minutes, explaining his rationale, why he sold all of his stocks. Like the title has said itself, I sold all my stocks. It had 250,000 views back in May 11, 2020. This is amidst the lockdown. People are still panicking at this point in time. Let's listen to him briefly and look at his rationale why he sold all of his stocks during this time.
How's it going, everybody? This is Victor Bush. So, I sold all my stock, and in this video, I'm going to talk about why I did that. Right now, I'm at about 22% stock, and I am getting very, very close to just liquidating all of it. I might be doing this on Monday or Tuesday or the coming week, but as you guys know, I was roughly at 78% stock, and I dramatically sold a lot of it right around Friday or so, and now I'm down to about 22%. If it inches up a little bit more on Monday or Tuesday, I definitely will be liquidating all of it. Now, why did I do that? In my previous videos, there are certain instances where I am more and more certain about a certain situation that I would actually go out on a limb and make a video about it saying I sold certain thing. For example, I sold Tesla stock, I sold Bitcoin, right? Those happen to be really lucky calls. And somehow I think I'm a genius investor just because I sold near the top and profited a lot from it. But this is another instance where I feel like the risk versus reward is just not worth it. And that is when I decide to sell everything. Let me impress upon you guys the severity of this situation. 22% unemployment rate. This is an extremely high unemployment rate. if you look at every single person in the United States, only 1 out of 2 people is working right now. And when you have people not working, people cannot pay for rent, people cannot even pay for groceries. And when this happens, people are not doing discretionary spending. They are not going out buying handbags. They are not vacationing. They are not going to hotels. With all this lockdown, this is a serious, serious issue.
So cutting it at that point, I think he presented a very well, like, rational based reason why he sold. So this is on May 11. If we're gonna take a look, uh, what do you think, Wowie? What was his, like, rationale back during those days? Definitely fearful days.
Yeah, those were fearful days, May 11, 2020, when he did that broadcast.
Mhm.
But everyone was scared back then. So it's a fear-based reaction to the market. Well, it took me a couple of months to
Mhm.
to buy COVID stocks. So what I'm saying is, when he released that video, I was in the same state. I was fearful.
Right.
And then a couple of months later, I had a few $100 to invest, and I started
Mhm.
buying some COVID stocks.
Right.
And they're doing pretty good. Those
Mhm.
COVID stocks, for our listeners' information, were Hilton,
Mhm.
Simon Property,
Mhm. So
Six Flags,
these are like
and
real estate companies, and Six Flags is an entertainment company.
then an airline company,
Mhm.
Southwest Airlines.
Oh, Southwest. I like Southwest.
So those were the ones I bought
Mhm.
during the COVID season, and they
Right.
did well.
So, yeah, going back to this guy, I mean, not to degrade him or anything of his investment decision. So definitely during those times are really tough. I would say he pointed it out. People are unemployed. How they're gonna pay their unemployment? But eventually the government stepped in. The Trump administration provided the relief, the checks, the stimulus checks, and the Fed announced its support back in March. So actually, if you're gonna look at the chart, when he sold at May, that's 9 days before the bottom of the market. So he definitely sold at the bottom, way down there. So if it's hard because you would say that emotionally, it's definitely soothing. If you can no longer sleep at night, you might as well consider taking your losses. But he ended up actually turning out to be like timing the market at that point. So he sold everything, and if he didn't like get back into it 9 days later, he would have missed almost doubling his portfolio. Because from that bottom at March, or let me see, May 20, right? May. So if he sold here, the market has already been recovering during that point. So if he sold there and already contented, he would have missed another 50% or 48% gains in his portfolio. So what I'm just trying to point out here is, like, definitely you need to check yourself in terms of emotional capacity in terms of investing. If you can hold, just try to stick with the investment. If you think there's something fundamentally wrong in that company, then you might as well reverse your investments in the company. But overall, it's definitely hard to predict where the market is going. I mean, right now we're just criticizing. It's like hindsight is 2020. Oh, he lost a lot of money if he didn't go back in the market and he sold right away. But during those times, there were those, like what Huawei said, are still like very troubling times. Unemployment rate, 1 out of 2 people not working. That's like a crazy amount of fear in engulfing all the investor sentiment that time. This is just a next clip that we're gonna play. This time it's gonna be from Aswath Damodran. He's the dean of valuation in terms of valuing a company. So we're gonna play that clip. This is from CNBC.
Finally, Professor, we were interviewing the CEO of IMAX this morning about the valuation, and I think he was trying to be a little bit polite, but he basically suggested, "Look, I don't understand the valuation, but I'm having an open mind that maybe models are changing over time, and I wonder whether or not you think the things we've lived by for decades revenue multiples, earnings multiples, enterprise value, equity value. Are they eroding on the margin in terms of relevance, or is this just a silly season?
I know people are not going to take this kindly, but I think old time value investing was lazy and sloppy. I mean, you look at a PE ratio, invest based on that, expect to get rewarded. I think those days are done. I think you still need to think about value, but you need to think about it creatively. It can't be just what did you make last year? What's the existing business model? You need to be open to the fact that business models are shifting, that there are companies that might not look good on a traditional value metric now, but are still good value investments. So I think if nothing else, it's a message to all of us that we can't just depend on the old metrics and get away with it because the world is shifting under us.
Ooh, Wowie, what do you think?
That goes against the grain, right? So
Yeah.
he's he's one of the top experts when it comes to valuation.
For sure. Yes.
So that's a big statement coming from Aswat Damodaran.
Yeah.
right?
We're looking at his bio here in Wikipedia, and is a professor in New York University Stern School of Business. He's been around for a while too. He's known as a dean of valuation. If you look into his reports, definitely he breaks down the company's perspective and different segments down to its growth potential and values each and every one, and then sums it up. Like he's into like sum of all parts in terms of valuation. So he's very well known for his valuation metrics. So he's saying like old school doesn't work, or the ground is shifting underneath us. So definitely something to look forward to. Because I myself, I would say I'm guilty of that. Like whenever I value a company, like what we have mentioned, like Apple or Google, whatever, I look at their balance sheet primarily, and then if I see a lot of debt in that company, it's an easy pass for me. I'm like, forget the growth or whatever, forget the prospects. I'm easy pass on those companies. But it looks like, yeah, if you're gonna look at some examples, Uber or Lyft, these companies, even Amazon, they listed their stock 1990, or they started their business 1996. I mean, their growth was enormous back in the days. Even now, they're still growing. But as late as 2016, 2017, I was still a heavy like critic of Amazon because they have lots of debt, even though that they're growing their sales 100, 200%. Netflix also, I was a very like critic back then, but I eventually buying a little bit of shares. So I think he has a very good point here. If I'm going to stick with just probably looking at the classic valuation metrics, then maybe I would be left behind in terms of like reaping the benefits of investing in high growth companies.
You have to look at companies now like a big network
Mhm.
of other smaller companies. So you have to look at the symbiotic relationships between supply chain.
Mhm.
Aside from looking at the financial statement of the company,
Right.
you have to look at how they are playing the market, using different contractors,
Right.
looking at their network of suppliers. I think that's a big deal there.
Mhm.
How resilient is their company?
Right.
So when you see a lot of debt, you expect, are they growing something? Are
Mhm.
they building something?
Right.
Where is that? What is the debt for? So
Right.
once you see where that debt is being used, then that gives you an idea. Plus, you have to look at the company's leaders.
Mhm.
You just look at Elon Musk.
Mhm.
He's very good at gaming the market. He would make a statement and then things will swing. But that's only for the short term. He can affect the market that way with certain statements on Twitter. But after a few
Yes.
years,
He can definitely
that
move markets.
he can, and we've seen that. But after a few years, that may fade off. So then you have to go back to the traditional way of looking at his financial statement
Right.
of
Mhm.
Tesla. And so I'm not going to rule out the traditional market
Yes.
valuation,
Yes.
but you just have to realize how leaders are gaming their company,
Mhm.
preparing it for growth
Right.
and stuff like that. And then
Mhm.
after looking at how the company leaders are directing the company, you have to look at how the market is reacting.
Right. I
So
think. Go
so
ahead.
how are the people reacting to what, for example, what Tesla is doing? So there's a lot of hype. People like clean energy, etc.
Mhm.
A lot of movement in the ESG factor. So it's popular right now. So what is
Mhm.
popular? So you kind of get a sense of the trend.
Right.
You know.
So it's like finding the good balance. It's not just always value. If the company has high cash and no debt, you buy the stock. You need to look at its growth prospects as well. What I'm looking at is like moving forward, we're going to take a deeper dive in terms of like not just a balance sheet. Moving forward, we're going to look into prospects of growth for sure. Because if a company is going to deliver like flat growth next year, then where's the stock going? If there's no growth story, then probably the stock will be flat. So here's another quote that I was able to get from one of the Wall Street greats, Peter Lynch, similar to what Aswath had said. He says here, Peter Lynch said, quote unquote, stock picking is both an art and a science, but too much of either is a dangerous thing. A person infatuated with measurement who has his head stuck in the sand of the balance sheets is not likely to succeed. If you could tell the future from a balance sheet, then mathematicians and accountants would be the richest people in the world by now. Definitely is
Mhm,
a wake up call. Another wake up call.
mhm.
Oh well. So yeah, definitely something to add to our weapon in terms of dissecting companies. Like for so we're now gonna jump on to our main topic, which is the Grab, our stock of the day or stock of the week. Grab. Wawi has pointed out previously we've been discussing Didi Chuxing or Didi Global, the one that just listed. So we're taking a closer look at this Grab. This is their website. We're just browsing through it. For our listeners, don't worry. We're just looking at their impact in terms of appeal. Looks like it's really good. They have deliveries, services, Food Mart, Express, send packages. So they're like a mini UPS too. Mobility, they have rides. I initially thought Wowie that they're just doing rides, but looks like they have
Mhm.
like food
And they were.
delivery, Mart, and they also have interestingly they have financial services. I mean, look at this. Like their website already shows that they're highly diverse in terms of their service. They have even insurance. They invest. They provide
Mhm,
investment services. This is
mhm,
incredible. Like this company is all over the place in terms of and how they present themselves to their investors. They say they are the Southeast Asia's leading super app, deriving economic empowerment across Southeast Asia. They say that
mhm.
they're all in one platform for everyday needs and everyday entrepreneurs. So, I mean, definitely, I looked over this before. I thought they were just a driving or on call app for Uber there in Asia, but they definitely have lots of services. They even have pay later, they even have remittance services. I might take a closer look at this. There's
I
this.
think that is
Mhm.
something new that was hastened by the COVID-19 pandemic. Because I remember when I went home to the Philippines in 2019,
Mhm.
uh, the Grab service was mainly for rides and
Mhm.
deliveries. So now that we're taking a deep dive, we're seeing that they're in the investment market as well. Wow, and look at that. Look at
Mhm.
the potential
Right.
addressable market.
So they have a graph here for our listeners showing like the Southeast Asian market opportunity. That's how they entitled it. There are over 670 million population in Southeast Asia, which is twice the size of the US. US around 270 or 260, and 6 in 10 people in Southeast Asia are unbanked or underbanked. So they're looking at this as their market potential, total addressable market of 180 billion worth. So looks like this is definitely promising. I'm
Mhm.
looking at their some of their more specific numbers. We're gonna compare it to Uber. Well, it won't be justifiable comparing it to Uber because Uber is not providing any financial services, but it still kind of trends in the same kind of like path in terms of providing ridership. We're also going to compare it to Didi. So Didi, as of yesterday, before today's open, is valued at 55 billion. Uber is valued at 84 billion. Lyft, I mean, Lyft is not a big competitor for sure, but it's at 18 billion. And Grab is planning to list at a valuation of 40 billion. So Didi at 55, Grab at 40. So this is kind of interesting because there are some commonalities between the two. Didi also started their business at 2012, while Grab also started during the same period of time. So Grab is definitely also known as the super app, or what they would like to name themselves. What they're thinking of is like listing in the Nasdaq via SPAC merger later on this year. What's interesting about the valuation of Grab is now they're targeting 40 billion valuation. But just a little bit of like fact here, just 1.5 years ago, back in October 2019, they were just valued at 15 billion. So now they're looking at 3 times the value, probably because they're trying to justify their growth. Now we're growing a lot more. But I took a research and look at their numbers for 2020 during the pandemic. They delivered a revenue of $1.6 billion in comparison to Didi, which is a close peer, I would say. Didi delivered $22 billion. So it's a ways to go. Didi has a revenue 22. Grab, with all its prowess in Southeast Asia, only delivered 1.6 billion. They didn't make any money, as most of the growth companies are nowadays. They delivered losses of $800 million, comparison to Didi, which delivered 1.6 billion losses. So in comparison, they're not so much into profit, similar to Didi, but definitely a lot less business at this point in time. Maybe in the future they'll grow. The company, as we're taking a closer look now with their growth prospects, they're saying that they're going to grow at least 40% on 2021 each year to 2023, 40% revenue growth in the near future. So it's going to be, we're looking at $2 billion this year, 40%, $2.8 billion in 2022 and onwards. So they're slowly growing, but not as big as Didi for sure. They're going to be listing in partnership with a SPAC or a blank company that's already listed in the Nasdaq market. The company's name is Altimer Growth, or ticker AGC. I look at Altimer Growth, Huawei, and it definitely is a blank company. Like, it doesn't have any significant operations. It was just founded in 2020, and it's based in, Menlo Park, California.
So you see that Altimer might be the SPAC company that's gonna put this on Nasdaq.
They're gonna be the ones partnering with, yes. And based on a
Okay.
recent interview, Grab CEO confident that the SPAC deal with Altimer is gonna close by year end after delay. So the delay here is not just an ordinary delay. As during the SPAC boom, I would say, when Palipatia was still, Chamat Palipatia, a famous hedge fund manager, who's been tweeting all about this and suddenly disappeared after the SPAC started bursting one after the other back in March, April. The SEC here in the US ordered for SPACs to revise or at least provide more information to their prospective investors. So as a result, most of the SPAC listings has been delayed because they have to reconsider what they're providing, their numbers to their prospective investors. So initially, Grab was supposed to list this summer, but they got delayed until the December. And then the CEO is proactively saying that he's confident that they're going to be able to list before the end, or at least at the end of the year. So the SEC is requesting for blank check companies such as this one, Super Apps of Southeast Asia, to have an audit of the past 3 years. So he said here in an interview in Bloomberg that we decided to be proactive, quote unquote. We wanted to set the bar in transparent financial reporting. It may have taken a little longer than we expected, but yeah, definitely he's looking at being listed in the stock market. It says here, quote unquote, we are just excited about the region. This is referring to Southeast Asia, and that we are excited that Grab is an early one to represent Southeast Asia on a global stage. So definitely an optimistic person right here, Wowie.
Yeah, something to look forward to at by end of the year if they do go ahead and IPO.
Right. So I guess that does it for the very dissected discussion of a specific company, Grab. So before we jump onto the conclusion, Wowie, do you have any quote for the week?
Yeah, my
Mhm.
quote for the week is from Ralph Waldo Emerson.
Mhm.
He's an American essayist, poet, and key leader of the American Transcendentalist movement.
Mhm.
So what he said was, the desire of gold is not for gold. It is for the means of freedom and benefit. So people that are investing in the stock market, you're thinking, oh, okay, they're just interested in money, 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 money. But really, you have to figure out what their goal is.
Mm.
Sometimes they just want to retire early, Sometimes they just want to buy a car or maybe buy a new house by investing. So um, as you strive to build your credit, your stock portfolio and bank account, keep in mind that those zeros you're adding to your statements are not what matter. It is the opportunities, freedom, and life they can provide you with. That's what's important.
Right.
That's why you are investing.
Right. That's actually really like a in-depth quote, as I would say,
Mhm.
because we currently in my situation, like most of our coworkers in the medical field, we work for money. We bargain. We spend our time to gain money, but later on, I think it's the time that we spend for sure with other people that are loved ones and all that are
Mhm.
the true richness or the true essence of why we're trying to build wealth. Oh wow, that's a deep quote, Wowie. Most of the time, I usually focus more on Peter Lynch and those type of like Wall Street greats, but this is definitely one for the taking. So for next week, listeners, we're gonna take a further deep dive in some of the largest banks, maybe BlackRock or um, Bank of America, JP Morgan. Look at their balance sheets as well. And one of our listeners raised to us if we could discuss the 401k and Roth IRA more in depth. So we're gonna tackle that as well. So hopefully you stick with us. Subscribe to us if you haven't done so. Give us a thumbs up if you like the if you like our content. Well, Wowie, thank you so much for coming on. Listeners, that does it for this
Thank you,
episode
Mark.
of Mark You and Wowie Show. Send your questions, or if you just want to say hi, send us an email at markuwowieshow@gmail.com or tweet me at marku_dpt. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And this is Wawi Santos signing out.
All right.